Hello, my name is Hector McNeil. I'm a co-CEO and co-founder of Han ETF, Europe's leading white label ETF provider. We're going to be doing a panel on all things Europe now, so hopefully it's not too alien for everybody, and hopefully you'll understand all the accents. We haven't got subtitles, unfortunately, but if you're struggling to understand what we're saying, just raise your hands and let us know. So the format today is going to be, we've got 4 excellent speakers from all different aspects to the ecosystem in the European ETF market, and we're going to be going through a range of questions for them. So we'll just start with, with Lorena first, a quick introduction of who you are and who you represent.
Well, thank you so much, Hector, and lovely to be here. I am Lorena Dunn, a partner in the Asset Management Investment Funds team at A&L Goodbody LLP in Ireland, and we represent a range of regulated funds across the UCITS and alternative spectrum, but we do specialise in ETFs, so it's a great opportunity for us to be here today.
My name is John Shields. Thank you for letting me be here today. I'm very grateful. I'm the head of business development in the Americas for Han ETF. My background is primarily in the US ETF industry. Back in the Stone Age, I was a market maker at the American Stock Exchange, trading ETF and equity options. I since parlayed that into a career in ETFs, working at both small and large ETF issuers, primarily in product roles, but also with a smidge of capital markets and operations as well. The longest stretch of time was over a decade at Spider ETFs, where I launched over 60 ETFs in the US. I joined Han ETF a few months ago, and as Hector mentioned, we're the leading white label ETF provider in Europe. We got our start in 2018 with our first fund launch. We've now grown the platform to 50 ETPs, working with about 30 different brands, and have about $9 billion under management. In the last few years, we see tremendous interest, not only from US managers, but managers in Canada, Latin America, and South America, interested in pursuing a UCITS strategy in Europe. And my remit is to kind of corral that interest and onboard those managers onto our platform and get them into the European ETF market quickly, efficiently, and cost effectively.
Hello, my name is Rafael Zayas. I'm head of portfolio management trading for Vident. We work with a variety of asset managers here in the States, but also in Europe, launching UCITS with Han ETF and others. Very happy to be here. I've been part of helping build ETFs for the greater part of 18 years at this point. And I'm happy to talk about some of the things you might want to know from an investment management, capital markets, and operational perspective as you're looking at Europe.
And Sebastian Jacob, Chief Revenue Officer at demystify. I actually started my early career in Europe, in Switzerland and in the UK in asset management, before I came to the US, so I have a pretty decent perspective on the similarities of the two markets, but also the differences. I usually have the honor of telling my American colleagues that there is no such thing as Europe. There's many different countries, many different segments, many different trends. And at TMX Verify, we describe ourselves as a differentiated index provider. So we're an index provider at our core, but we also support ETF issuers with distribution and analytics support. Have historically done that in the US, but recently expanded into Europe.
Thanks, everybody. That's one of the best things I'd say about coming to Europe is the road shows that you do. You know, in a couple of weeks you can do Milan, Stockholm, London, Paris, Amsterdam, etc. And that's probably the biggest pull of all of it, to be honest. So, Lorena, I'll start with you. Obviously, active ETFs has been huge growth in the US, but we're starting to see that in Europe. Do you want to just give us some of the regulatory landscape in that area?
Sure. Well, I suppose first of all to say that active ETFs are ETFs, and in that sense they are UCITS. So I think one of the questions we get a lot is how do we go about authorising these? What are the differences for us in terms of setting up an active ETF in Ireland versus setting up a mutual fund? So as I've said, ETFs in Europe, they're always going to be UCITS. That means that the regulators are going to treat them as such. So from the central bank's perspective, the authorisation process, the timelines are going to look very much the same. Similarly, active ETFs and passive ETFs are treated in the same way. So I think there's some comfort in that. I suppose one of the regulatory requirements that's come up a lot in the context of active ETF discussions had been the central bank's focus on the requirement to make full daily portfolio transparency disclosures. And that was a big concern for active managers because there was really that sense of giving up their intellectual property around the portfolio. So happily, last year, the central bank decided to relax its rules around making that full daily disclosure. And it relaxed that in two ways. So firstly, it said, right, we'll allow periodic reporting of that disclosure. So that can be anything up to quarterly disclosure. It's up to you to make the decision, and I suppose with your APs and market makers, as to what's appropriate there. So that's the frequency point. But secondly, in terms of the content of that disclosure, there was also a relaxation of the rule. Now you're required to disclose appropriate information to your APs and market makers on a non-discriminatory basis, which of course goes to the general UCITS rule of fair and equal treatment of shareholders. So that's been a real positive, I think, for active managers looking at the space in Ireland. I suppose when you're looking at what appropriate information means, that's something that would require some engagement with APs and market makers, but ultimately this does not necessarily amount to full portfolio information being disclosed. So we've been very pleased with that in the Irish context, and I think it aligns better with what we've seen in the EU more broadly. Definitely we've seen a huge amount of traction in terms of active fund launches on the ETF side. There's also a huge amount of interest, and we do think there's a lot more to follow, particularly now that those rules have been relaxed.
And I think one of the important points to note about portfolio disclosure, in Europe there's no restriction on time zone, so you can have non-disclosure for all geographies, so you can do EM, Latin America and Europe at the same time. And it's principles based rather than rules based as well, so there's no approvals of systems like you had here with Blue Tractor and T-Row, etc. You can have any system, it's pretty much principles based, isn't it?
Exactly.
So, Raphael, you've done lots of effectively outsourced portfolio management for ETF providers in the US. Now you're seeing a lot more in Europe as well. What are the sort of commonalities and differences that you're seeing between the markets?
Yeah, so certainly it's the case that the products are a little bit different. So we're still seeing, I'd say that the U.S. has already been mentioned, U.S. is quite a bit ahead as far as active management and active managers entering the ETF ecosystem. To that point about disclosure, I think we're seeing that American managers have already, it's been a process to get there, but I think active managers are generally now comfortable with the concept of daily portfolio disclosure, and that's been necessitated by the pressures of the U.S. ETF market. And so I think that's making it easier for them to enter the European market, where I think, generally speaking, European managers are more hesitant to participate in products where there's daily disclosure. So that's one of the big things. Still seeing some thematic and smart beta. One of the biggest things is that Europe is quite a bit ahead of the US in quite a few areas that I don't think people in the US appreciate. So for instance, the UCITS market is leaps ahead as far as cryptocurrency and commodities products and a variety of products like that. And so they're well ahead, and they've been laughing at us, as Hector says, as we've been, kind of been all excited about our Bitcoin launches. So that, and then they've been ahead on some other niche things, like AT1s and COCOs and some other things like that. But I think in the US, we're seeing, the prevalence of defined outcome products and products with options. I think that's still a growing area for Europe. So I think in that case, so I bring that all up to say, I think there's different niches of product types where Europe is quite a bit ahead of the US, and where the US, I think, also is ahead of Europe in certain product types. And one last thing I'll just mention is that from a regulatory standpoint, all of your processes and procedures, they are kind of thematically very similar between the US and Europe, but quite different all the way. So and there's a lot of vocabulary you have to learn related to what's a management company, what's a manco versus investment manager versus what is your liquidity risk look like, and how do you think about that from a policy and procedure standpoint in Europe versus the U.S. and things like that. And so it's a lot of little things, but working with I think working with an established firms and distributors in Europe kind of helps guide some of those paths very well. So I think it's been interesting to watch.
Thank you. Similar question to you, Sebastian, the sort of indexing trends you're seeing in the US, what's interesting there, and what you're seeing in Europe, and what's common and what's different from the two markets?
Yeah, so what you just mentioned about options-based products, that's definitely a trend that I think is still in its infancy in Europe. I think the total market, depending on how you count it, is about $5 billion US, whereas in the US, it's a category for itself already at about $200 billion. So that's options-based strategies, collar strategies, buffer ETFs, of course, which are big in the US right now. What many managers, global asset managers, are doing is they look at their lineup of options-based strategies, they pick the best ones and bring them to Europe, bringing the crown jewels to the European market. So that's definitely one trend. I think another one that we're seeing is in the US, we're very much in the mature phase of thematics 2.0, meaning durable, long-term thematic trends as products, as opposed to short-term fads or short-term trends. So think of AI, defense, those kinds of products. They're very much, again, at their maturity phase in the US, and they're slowly coming to the European market as well. I'm not going to repeat what you said, vice versa. There's a lot of people in the US who think, generally speaking, the European market is 3 to 5 years behind. That's true in many aspects. That's not always true. Crypto is one good example. I think also the prevalence of retail investing and, in Germany, for example, you have a lot of these discount savings platforms that drive a ton of the retail ETF flow. We're seeing some similar dynamics in the US. They're very slow to materialize, but I think it's worth looking to Europe, especially some of the continental European countries, for trends that we might see in the US as well.
Yeah, interesting you mentioned that, because one of the firms I first founded, ETF Securities, we actually invented gold ETFs. Our gold ETF was a year out before GLD. And funny enough, I looked at the share price, the actual price of gold, when we brought this out in March 2004, and the gold price was $418 when we brought that out. So the gold's gone up tenfold since ETFs were available, which is pretty interesting. So John, do you want to tell me what the range of options people have for entering the ETF market in Europe?
Yeah, happy to. Generally, there's 4 different ways you could go about doing it: buy, build, partner, or white label. Starting with buy, that is obviously a very expensive option and one that has significant integration challenges, particularly if you're talking about a cross-border transaction. And also, if you look at the European ETF market, you'll see that most of the major players are already associated with large asset managers or banks, so it's really not a very target-rich environment for acquisitions. The build route is still very complex, very expensive, and comes with very high execution risk. To succeed there, you'll really need to understand the nuances of a different regulatory regime, multiple listing venues, multiple languages, multiple currencies, and a whole host of things that are just different than how they are here. Not to mention capital markets. APs and market makers are very hard to secure in Europe right now for new entrants. So all in, you're looking at probably 1 to 3 years just to get operational. Factor in a 3 to 5 year learning curve to course correct the mistakes you made along the way, and an investment of anywhere from $2 to $10 million to get you there. So again, not an ideal situation to build on your own. Partnering is probably the most cost effective, but you give up a lot of ownership and control over your funds and strategies. On day 1, your economic incentives may be aligned, but year 5, priorities could be a lot different between you and your partner. And also, you give up a lot of the upside once you get to scale. That tends to benefit more on the partner side. And lastly, in the case of a dispute or dissolution, you're likely going to lose those assets, and they're going to go to your partner. So the one option that I'm particularly partial to, the white label option. I think it's a pretty solid one. I can't speak for other providers, but at Han ETF, we are first and foremost an ETP specialist and first and foremost an ETP white labeler. We're the only standalone ETP provider, white labeler in Europe. We're not part of a larger financial institution. And again, our focus is exclusively on ETPs. We have a staff of about 60 that does nothing but ETPs and has deep experience doing this. When you look at our leadership, and as Hector mentioned, our C-level leadership alone has launched over 1,200 ETPs over the course of their careers. And that includes the first ETF in Europe and the first ETC in Europe. So you come with us, you get speed. We'll get you in market in 3 to 4 months. You come with us, you get the benefits of scale, which will help in the platform approval process. And you get the benefits of our distribution team from day one. And I say most importantly, you get the immense benefit of savings, measured in both years and millions of dollars. So we estimate that using our platform can basically cut your execution risk by about 80%.
And I think it's true to say that the big differentiator between the white label solution in Europe and the US is distribution, isn't it? Because that's the biggest challenge everybody has, right?
Certainly, yeah. We are the only white labeler in Europe and in the US that has kind of a full stack sales and distribution team. So supporting marketing as well as wholesalers out in the market.
Excellent. And Lorena, the question I always get asked for audiences like this is tax. You know, there's a big tax reason why people want to move from the mutual fund market to the ETF market. And everybody says that doesn't exist in Europe, but it does exist in Europe, doesn't it? But it's slightly different. I don't know if you want to take us through that, side.
For sure. Look, we know in the US there's a very specific tax advantage for the investor to invest in an ETF versus a regular mutual fund, let's call it. Unfortunately, that is not the case in Ireland. I suspect most of the EU ultimately investing in an ETF is very much from a tax treatment perspective, from the investor's perspective, the same as investing in a non-ETF UCITS. However, there are other benefits to being an ETF as opposed to a non-ETF UCITS in Ireland. And the main one is access to the US-Ireland double tax treaty. So because of that, an ETF that's launched in Ireland will benefit from 15% withholding tax on dividends paid by US companies, and that's as opposed to a 30% withholding tax that will be applied for UCITS that are not ETFs. So there is a significant advantage there, and that's definitely been something we found useful in attracting passive managers over the last 10 to 12 years to the jurisdiction, but also I think from the active manager's perspective, when you're weighing up where to launch your ETF, there's definitely that element of this is really alpha, that tax benefit, and it's something to bear in mind. It's also not the kind of advantage that you're going to get if you set up somewhere other than Ireland. So I think that's my green flag waved sufficiently.
Yeah, and I think that's really when you talk to a lot of certainly US managers who've got UCITS funds already in Europe. One of the reasons they are looking to switch out the UCITS funds into the ETF is to get that uplift on withholding tax, or saving 15% US withholding tax when you might have a US holdings of say 50-60% in your portfolio. That's a huge uplift on alpha that you can get just through structurally changing the wrapper. Raphael, what do you notice the differences between passive and active managers when it comes to your function?
So one of the biggest things that active managers kind of sometimes bump their toe on when they're thinking about Europe is I think some firms and some not, but rely pretty heavily on soft dollars, where that's not going to be feasible in Europe. And so you really do have to reevaluate that from that strategy. So especially for active managers, right, where they rely on those research dollars to help fund their investment process, that's something quite serious you have to think about. There's a benefit to not having to worry about the tax benefit of the custom redemption process or the heartbeat trade, that I was talking about. That does free up active managers to be a little bit more active, right? They don't have to worry about, what other capital markets activity is going on in their fund as they're trying to rebalance. They can just, execute trades though. So that's one of the other benefits for comparing a US active manager to a European active manager. And And then obviously disclosure we've discussed. And then for different investments, so for equities, I think that's a lot of it. For different asset classes, though, like I said, the structures can be a little bit different. And so you really want to just think about what your product is and think about that in the context of tax and what does the investment process look like. One other thing to keep in mind is that because the create redeem process in Europe is one thing to mention is it's a cash driven process. So there's cash creates redeems, and so that infers you're going to have a lot more connectivity to different brokers than a US manager might normally have. You have to be connected to a lot of the main market makers and authorized participants in Europe in order to support the create redeem activity, because that is all quite directed and there's pre-negotiated commission rates which help drive down this bid-ask spread. And so coordinating that across your trading team is quite a bit different than I think a lot of managers are set up for. And so that's just something you're going to have to tackle as part of onboarding. I think that's some of the highlights there, yeah.
Fantastic. Sebastian, you've got a very broad footprint with US issuers and how you support them both from indexing all the way to media and marketing support. What's your vision for Europe? What we're finding, whether it's working with people like US Bank, Kel Gates, Ale Goodbody, US Bank, JP Morgan, a lot of the US businesses are porting clients over to Europe. And I assume that means that ecosystem they already have is porting over to Europe as well. Is that what you're seeing in your role?
So the short answer is that what we're trying to do at TMX Verify is use the value proposition that we have built in the US and migrate that to Europe. Primarily because the two foundations or the two main considerations for why we built the business the way we did, they exist in the US exactly as they do in Europe. So the two foundations are, number one, distribution is incredibly hard. Everyone in this room knows that. It's getting harder and harder as the markets, as the ETF market becomes more saturated. That's true in the US, it's certainly true in Europe. Like I said before, there is no one European market. You have to understand the intricacies of the different countries, and even within the countries you have segments that have idiosyncratic behaviors that you can't just play with a one-size-fits-all approach. So distribution super hard, which is why the approach of indexing plus distribution support works in Europe too. And the second consideration was that ETF issuers in the US are increasingly unwilling to pay high indexing fees to their index providers for ongoing services, because there's a perception that index providers just don't add value in the long term. They leave, they write you a cheap call option right after they built the product for you. And so we're trying to address both things. Help with distribution, and because we help with distribution, we want to earn our fees, we want to lean in and help you with distribution support with perfectly aligned incentives, because if we help grow the products to scale as fast as possible, we make more money, just as the asset manager. And so we want to move that model into Europe. What that requires is a built-out media platform, distribution platform. We have that in the US, we have that in Canada, and we're just getting started in Europe right now.
Fantastic. And, I can lay testimony to that, how I think more added value that Verify bring for actually having proper salespeople who can go out and support the IP with the team, and I think it's actually a really strong feature for the business from that perspective. And I wish that more index providers would adopt that approach to get the extra value from that perspective. So I'm a big fan of that.
Because they would eat our lunch, yeah.
Yeah, exactly. So John, Hans, there's just under 150 brands in the ETF space in Europe. I think you guys over here have about 600. So Europe's still at a very early stage. Lots of banks, lots of asset managers, not so much private companies, etc. But that's changing over time. And I think Han accounts for about 32 brands out of that 150. Obviously, you've got some big companies in that mix as well as some smaller companies. Lots of US bank clients coming over and using their platform in Europe to get into the space. What do you see the difference in the range of services that you offer to the bigger sort of clients and the smaller sort of clients? And is it a one-size-fits-all, or is it a smorgasbord of options?
Yeah, I would say it's definitely not a one-size-fits-all approach. We can work with managers of all sizes and kind of build around their needs. Our main objective at Hahn is to lower the barriers and the execution risks associated with entering the European ETF market. And we do that by reducing the complexity, cost, and time it takes to launch an ETF. And the way that you can kind of think of our services is two-pronged. On the one hand, we have our core services, which essentially handles everything to get you set up and operational in Europe. So it covers things like onboarding third-party service providers, getting all the regulatory approvals, getting you set up with capital markets, so APs, market makers, exchange, seed, getting you set up with all the necessary marketing documentation required under a UCITS compliance regime. So that sort of stuff just to get you kind of up and running and in the market. And on the other side, we also have what we call our enhanced services. So this basically gives you additional sales and marketing support. It includes access to our digital marketing program, access to our platform distribution services, and access to our wholesaling team. So the core services are a bit kind of standard in terms of how we get you operational. Where there's lots of flexibility and it's a bit bespoke comes on the enhanced side, where our clients can kind of pick and choose the services they need to kind of fit around their businesses. And I think we also can obviously handle fairly standard ETF launches, but we've also come across some fairly unique situations which we work with clients to get to market. Just last month, we converted an investment trust to an ETF, the first of its kind transaction in Europe. And we've had lots of conversations with other managers who have what I would call kind of legacy UCITS fund structures that they're looking to breathe new life into by turning it into an ETF. So we can handle kind of merging that structure onto our platform and converting it into an ETF structure. So again, we have a really flexible platform that can kind of build around your business needs, and we can handle anything from very simple product launches to fairly complex transactions to get you in market.
So we're going to talk about share classes now. Everyone in Europe laughs how excited everybody in the US gets about share classes. They seems to be every conference you go to, there's about 3 different share class events. In Europe, I'd say virtually every ETF has a share class and has done since time dot, and we find it quite bizarre. You can get a patent on a share class in any scenario. But anyway, so Lorena, you can talk about share classes and explain a little bit about the use and adaptability of that in Europe from that perspective. Yeah,
I sure can. I guess one of the main questions we get asked is, can you have ETF classes on non-ETF UCITS and vice versa? And the answer, of course, is yes. And actually, that flexibility has been there since 2018 in Ireland. However, there was quite limited uptake actually initially on that flexibility for good reasons, which I will come to. But maybe a couple of years ago, I guess, this came back into focus when HSBC launched an ETF, well, a number of ETF share classes on one of their unlisted UCITS fixed income funds. And of course, more recently, with the prevalence of interest in the active ETF space, it's naturally become part of the conversation again. So I guess the biggest barrier to relying on that flexibility from the perspective of a non-ETF UCITS of having an ETF class in the range was that the central bank had been requiring that the identifier UCITS ETF be included in the name of the fund wherever you were adding an ETF share class, and that just was not palatable to the majority of managers. So thankfully, last year, the central bank sort of recognised the need to relax that rule, and what we now have is a requirement that identifier UCITS ETF be included at the share class level only. So that's really opened up, I think, the world for managers to rely on this flexibility, and we're going to see a lot more of that. I guess one caveat is around tax, and it goes back to my overview of the US-Ireland double taxation treaty. We just caveat that for ETFs that are looking at including non-ETF share classes in a fund, you do need to look at whether that will limit your access to that treaty and those benefits that I discussed earlier. So to the extent that you are an Irish ETF that has significant US equity allocation, that might be something that won't be palatable to you. So just something to bear in mind when you're going through the pros and cons list of taking up that flexibility of adding a non-ETF class to your ETF in Ireland.
Yeah, and I think one of the areas that I think we'll see more of that we haven't seen yet, really, in the share class story in Europe, is you can do an unlisted share class, ETF share class, which basically means it isn't seen publicly and it isn't traded on an exchange. So it's effectively what I call a mutual fund share class. So it's the reverse of what everybody's trying to do generally here and in Europe in terms of getting a share class in a mutual fund. It's the opposite to that, by being able to do share classes that are not seen and not traded. So they create and redeem exactly like a mutual fund would do today, directly with a TA, and it also allows you to be able to do favourable treatments with clients on fees, etc. That's one of the other things I would mention as well. In Europe, you're allowed to do rebates on ETFs as well. So in lots of ways, that negates the need for different share classes as well. Because if you get a big client who wants to put 50 million or 100 million into a fund, you can rebate that client for that scenario outside of the ETF. So they pay the list price, and then they get the money back on a quarterly or monthly basis. So there's a lot of flexibilities. I mean, we've recently done for two clients, two big asset managers, Jupiter and Odo BHF in Europe, 10 share classes for their ETFs. So they've got multiple share classes doing different things. Whether it's currency hedging, whether it's accumulating, distributing, or whether it's different share prices, etc. So there's a lot of engineering you can do with a share class from that perspective. Sebastian, you've just recently bought ETF Stream, which was a sister company of ETF.com. Can you give us a little bit more information on that, and what's your sort of aims and objectives for doing that in terms of aiding the market?
Yeah, happy to. So, like I mentioned earlier, it's always been our goal to bring the U.S. value proposition to Europe. And so we had to make a decision whether to build or buy the media and distribution capability that we need in order to offer these services. Pretty quickly came to the conclusion that building a media and distribution platform from the ground up takes a lot of time, because you need to build the trust with the audience, which doesn't happen overnight. So we came across the ETF Stream team and really liked them from day one. I'd say primarily for two reasons. The first one is they have a very high level of journalistic integrity, which is important to the European audience, and I'd say even more important to European fund buyers than it is to the US audience. And number two, they have built very deep relationships, both with asset managers, but also with fund buyers and other investors. That's certainly something that you can't build overnight. That's also not a model that's very scalable, but so what they're doing is they have a hybrid approach. There's a digital scale play to what ETF Stream is doing, and then a very analog matching type of service between investors and asset managers that only works because they have these deep, intimate connections on the street. And so we're super excited to continue to support their growth. They used to be UK-centric historically, but have recently expanded into the continent. They're very active in Switzerland and Germany right now, soon also in France. I think last week or 2 weeks ago, launched a website for Germany in German, which my fellow Germans love. And so we're really excited about that platform, and what that allows us to do is like I mentioned before, offer indexing and then lean in as soon as the product is launched and support with distribution and analytics. There's also a lot that we from the US can help with from a capabilities perspective, especially when it comes to behavioral analytics. There's some challenges in Europe around GDPR, but nothing that we can't overcome over time.
And I think there's two points I want to make on that. One is that you mentioned briefly about the German market, and savings plans. And I'd say that if you do come to Europe, Germany is probably the poster child of the ETF market in Europe. There's going to be 32 million new savings plans alone in Germany. There's a big realization that the social welfare system isn't going to be there for the younger generation over the next 20, 30 years. So they're all saving, and they're all saving an average of about 500 to 1,000 euros a month that go directly into ETF models through neo-brokers. So that's the sort of retail revolution we've been waiting for in Europe, and that's starting to spread all across Europe. So I estimate there's probably going to be 50 to 60 million new savings plans in Europe over the next sort of 5 to 10 years. So there's a bit of a revolution going on from that perspective. And
Hector, non-representative anecdote, I just was able to convince my parents to go into an ETF savings plan. I've been working on that for 10 years. There is $17 trillion across Europe in these savings accounts that generate 0.25% interest rate. And like you said, the revolution is just getting started.
Very sticky money. In fact, I always tell our new clients that it's the first time my mum can buy their product, actually. So I use that line all the time. But and the other aspect I'd say is, well, we get asked by a lot of clients, what's the equivalent of exchange or events like this in Europe? And actually, ETF Stream run an event called the ETF Ecosystem event in May. So if everybody's looking for an event they want to visit to get a feel for the European market, then that's the event to go to in Europe. It may not be free anymore, but it's always been free in the past. But I don't want to put words in Vedify's mouth that has been in the past. John, one of the key areas for new entrants, and seems to be the obsession of any new party coming to the ETF market, is capital markets. Do you want to give us an overview of the hand solution for capital markets?
Yeah, so I would say three big challenges coming into the European ETF market are capital markets just operationally, getting seed for your fund, and then just the distribution across Europe. So very similar to what you have in the US, it's increasingly hard for new entrants to secure APs and market makers in Europe. For APs, it's extremely resource-intensive process and costly to negotiate and onboard new clients. And in fact, we're seeing some APs are actually now charging a fee to prospective clients just to consider bringing them on board. So at Han ETF, we work with most of the market makers in Europe, and we have over 20 APs signed on to our platform. So if you come along with us, you're guaranteed access to that liquidity ecosystem, which includes seed for your fund launch. On top of that, we have an in-house capital markets team that is dedicated to managing and overseeing all of our liquidity providers, securing seed for you, managing and overseeing the trading of our ETFs, and facilitating trades with ETF buyers. And lastly, like I said earlier, we have a full distribution function, a sales and marketing team that really helps drive flows into our clients' funds. That starts with a database of over 50,000 ETF allocators across Europe that we've built ourselves that we use for digital marketing opportunities. Generally, what we do is we'll work with the managers on our platform to reformat their existing marketing content and make it compliant under the UCITS regime. We'll then send out content such as videos, webinars, thought leadership, and other investment content related to our managers' insights, funds, and strategies. And from there, we generate leads that we leverage to our wholesaling team that we have positioned in all the major markets across Europe. And as Sebastian noted, Europe is very fragmented, and our wholesalers are kind of local language, local market experts, and really know how to penetrate into those regions and work towards finding prospective ETF buyers and pitching our clients' funds. So when you look at the breadth of the assets we've raised on the Han ETF platform, most of that has come through the work of our marketing and distribution team. So when you think of the three big challenges of capital markets, of seed, of distribution, Han ETF has a solution for all three that works very well for our clients and helps them scale their business.
I think one of the major wins you get when you come to Europe as well is, unlike the US, you can actually pay market makers. So you can actually pay a market maker a commercial agreement, which means from day one they'll guarantee the bid offer spread that you agree with them, and they'll seed the fund. So funny enough, I set up Susquehanna's ETF business late 90s, early 2000s, and we pioneered that solution with iShares. And I'd say that sort of like catapulted the industry, you know, to be able to do it. Because what that really does is allows you day one to say to investor, this is the market you will get irrespective of flows. So you've got a guarantee that the person on screen, so we don't have a concept of LMM in Europe, but we do have this concept, commercial market making agreements. So there's 6 market makers, we have commercial market making agreements day one that you will get access to, you know. So I think one of the biggest challenges we've got coming up is catastrophe bonds. Now I know there was an issue getting an LLM here. We've got 3 commercial agreements with market makers that will cover that day one. So we've got that solution out there already.
And then you can revisit those agreements over time, right?
Correct.
Which is another big benefit, right? To have that agreement and then be able to renegotiate it is quite incredible.
And you can moan like hell to the market maker. They're not doing a good job as well, because they're all of a sudden a service provider.
Yeah,
so,
exactly. They're a service provider, not just someone looking to get some commission dollars, for sure. Yeah.
And Raphael, turning to you, what's the sort of advice you would give to a North American firm entering Europe? What would you think they need to think about?
Yeah, so it's been very rare, but in the past we have, this is a while ago, but had seen some larger American managers thinking about trying to build a European solution. And I like that non-representative anecdotes, but it's certainly the case that they ended up spending a lot of energy and then the effort lost steam and just nothing happened. So I think partnering, is just a substantially lower barrier to entry. One of the mistakes that I think I have, small regret about is that we're thinking about like different vendors. So even just regulatory reporting, right? There's a lot of different regulatory reporting. You really want to have local expertise for a lot of those things. So you might be tempted to, see which of your local vendors here in the States support, European reporting services or some other service that you're looking for, right? And I would strongly advise you to actually look at European vendors for European services. The expertise is just much higher, and they could educate you about the things that you don't even aware of. Whereas if you're looking with a stateside vendor, it's just someone who's going to be, oh yeah, we can do that. So. Just a strong recommendation there. And I think a lot of that's like a theme, I would say, for if you're looking at Europe. Like, you obviously going to want to be comfortable with like local representation, local service providers, local distribution. You have to get used to the fact that there are very much local quirks to everything that, again, they're going to sound familiar to you because they are very similar, but they're just different. And so you're not going to, out of the gates, you're not going to have an ear for some of the nuanced differences between things you have to do in the States, whether it's liquidity stress test reporting or best execution and transaction cost reporting, right? There's just differences about how they think about it, and just working with partners who have that local knowledge is quite critical.
Yeah, I think that's a key difference. You almost need the Duolingo for the
exactly. Yeah.
Don't you? But I'd say that's the one of the biggest things we've built into our contracts now. It's a lot of the questions that people are going to have to come up with is they don't know. So it's often the fact that you don't know what you don't know when you enter a different market. And one of the lines we have in our contracts now is the ETF helpline. So you've got experts at the end of the line, whether it's distribution, market making, product structuring, legal advice, tax, whatever it is. You've got that helpline, which is really, really key from that perspective. Sebastian, what are you seeing from your US clients in terms of their appetite for coming to Europe?
So I think it depends a little bit on what client you're talking about, like mostly what size of US manager you're talking about. I think most asset managers, or many asset managers that we work with, they are already in Europe, or they have a strong appetite to go into Europe because they see the opportunity. I think if you just look at the growth metrics, it's very clear that it's an attractive market that asset managers should play in if they're not already. I think, Raphael, very much to your point, many asset managers go into the European market, try it out themselves. They treat Europe as one big monolith, and then fail. And so I think the best piece of advice that you can give, that we give to our asset managers, because we're also just a vendor, we can't make the decisions for them, but the advice that we give is call a friend. Try to get yourself a partner that really understands the market, and be targeted in where you want to play. So, we talked about the German opportunity, for example, which I'm most familiar with. The product trends are very different across Europe. So if you want to play in the German market, I'm giving out free product advice now, but everyone's hearing it, so it's probably not worth that much. There is a strong appetite in the German market right now for targeted fixed income products, especially target yield products, which are very similar to what the German average investor is used to. That's a trend that we've started to see in the U.S., and that's definitely ripe for some of the continental European markets, Germany, France. But the main piece of advice that we always give, just to reiterate that, is find yourself expertise if you don't have it in-house already.
Yeah, and I think it's true to say as well, if you've got a product or a company that wants a global brand, i.e., you have a really good idea in ETF. If you have the 40 Act product and you have UCITS, you pretty much cover the globe, because UCITS is broader than just Europe. It's Latin America, it's Asia. It tends to be the more benign tax structure for those markets than the US 40 Act. So if you want to protect your IP globally, if you've got those two wrappers, you pretty much cover the globe from that perspective.
And you get yourself optionality, right? You don't always have to play in every single market or focus on every single market at the same time. Once you have the UCITS wrapper in place, you can go to France first and then play another market at a later time, as and when the market is ripe for that product exposure.
Yeah, and what's good about that is the passporting and registration of funds across Europe is very straightforward. So if you do find a commercial reason to be in another market, for instance, we've added Poland recently to our fold. Poland's only got 15 ETFs listed there, but it's growing very rapidly. It's probably going to be the 5th richest country in Europe in the next 10 years. So the direction of travel is all that way. So you've got Germany at one end, Poland at the other, but it's all moving towards ETF adoption. I mean, we recently just gone through 3 trillion of assets. When we created Han in 7.5 years ago, the market was 700 billion. So it's growing at the same 20 to 25% compounded rates that you're having here, but it's just that little bit further behind from that perspective. Lorena, do you want to just talk about, from your perspective, the differences between dealing with somebody who wants to build their own infrastructure and their own platform versus doing a white label solution?
For sure. Well, look, I think John has done an excellent job already at calling out some of the challenges around the build approach, which I guess is what we're talking about when we say going for a proprietary ETF platform. And from the authorization perspective, I guess, consistent with what you've said, it is a much bigger project than launching a sub-fund on a white label platform. As you, I think, already alluded to, you're choosing service providers. You're going through the process of negotiating material contracts with them. You're appointing a board of directors. There are particular requirements depending on the jurisdiction that you're in around that. In Ireland, they have to go through a fitness and probity process. You're also going to be, I suppose, negotiating a base prospectus, which is quite a chunky document with the central bank. They get to review that, and there's a lot of back and forth. So typically the process takes about 3 to 4 months from the point in time that you're actually ready to submit an application to the central bank, and there's a lot of work to be done before that. And I suppose fundamentally, as you already called out, in tandem with that, you're ensuring that you have the basic ETF infrastructure put in place. So you'll be dealing with your settlement models, negotiating your ICSD and paying agent arrangements, your AP and market maker agreements. You're going to be putting in place your capital markets infrastructure, your capital oversight policy that the central bank requires. And of course, if you're in the space of going down the sub-fund on a white label platform route, you're just plugging into that pre-existing infrastructure that's already there. So your concerns really, in that case, from an authorization perspective, just boil down to more or less 2 documents. So you're talking about a supplement, which is a relatively short document, very much fund specific, outlining the strategy of the fund, the types of share classes on offer, etc. that will need to be reviewed by the central bank, but that's a process that's typically not going to take much longer than 10 to 12 weeks. And in addition, you're putting in place your contractual arrangements with the investment manager to whom the portfolio management is delegated. So it's a pretty light list, you know, from an authorization perspective, when you're looking at the white label route versus the whole proprietary ETF platform.
Yeah, and I'll leave you, we're out of time now, but I'll leave you this thought as well, that you know, your white label solution versus build it organically. Build it organically is a 2 to 3 year journey. White labeling is 10 to 12 weeks. Just bear in mind that if it's a 2 to 3 year journey, iShares is twice the size they were when you started that journey than when you end it. So do you want to be there taking them on while the market's still growing 20, 30%? Or do you want to wait that length of time to deal with somebody who's twice the size they were when you started? I'd like to thank everybody on the panel. Sorry I haven't got time for questions, but obviously you can grab everybody today if needs be. But thank you very much for taking part. Thank you.
Thank you.